Recover your basis tax-free, but tax-free zero cost or index loans are far better. Why? In this episode, I am going to address the question, how does IUL, Indexed Universal Life, provide tax-free income? Get ready. You're going to learn something that most financial advisors do not understand. So I'm Doug Andrew, and I began in the financial services industry clear back in 1974. And from 1974, when I got my Series 1 securities license and my insurance license, I ended up being responsible for over 3,000 clients in 13 Western states by 1980. And I sold a product that was a term insurance with an annuity rider where people could save money, 2/3 of every dollar they set aside, accumulated at 7.5% to 8.5% interest in an annuity. Or most of my clients would assign the annuity cash over every 90 days to a mutual fund of their choice and sort of utilized quarterly dollar cost averaging, if you know what that is. So the point is this, when people began to come to me, they usually wanted a vehicle where they could accumulate their money on a tax-favored basis, hopefully totally tax-free, to be able to use for goals such as retirement or working capital for business or real estate management, emergency funds, and so forth. Well, Universal Life back in 1980 was the brainchild of E.F. Hutton. They weren't an insurance company, they were a brokerage firm, and they realized that under 3 sections of the Internal Revenue Code, there's only one instrument that allows you to accumulate your money tax-free under Section 72E of the Internal Revenue Code. All interest, dividends, and growth are totally tax-free. But then you can access money while you're alive totally without triggering tax if you do it the smart way under Section 7702. And then when you ultimately die, anything left behind blossoms, increases in value, and transfers income tax-free under Section 101A, and that's life insurance. But see, most people, they either bought term insurance to cover in the event of a premature or untimely death, or they bought whole life insurance. Well, whole life was built on a chassis that is not the best if you're going to be using it for income. Universal Life is a superior instrument to use it for tax-free income in retirement. So I'm going to explain how this works simply, and there's a lot of other educational videos on this channel that will also help you understand this. And I'm going to gift you a copy of one of my most recent best-selling books at the end of this episode, so stay with me. So for years, I've had thousands of people reposition serious cash in lump sums or in periodic deposits, monthly, annually, or whatever, into max-funded Universal Life policies in order to increase the liquidity, the safety, and the rate of return. Now, on this channel, I talk about why Universal Life and Indexed Universal Life passes the liquidity test, the safety test, and rate of return test with flying colors. Let me talk about accessing money for retirement, because a lot of people use max-funded Universal Life or Indexed Universal Life for that purpose. Now, Universal Life was the brainchild of E.F. Hutton back in 1980. That was a high interest environment, and I never earned less than 11.75%, even as high as 15.5% on my Universal Life policies from 1980 to 1990. And my clients were never happier than when I got them out of the volatile market for that. But then in the 1990s, interest rates started to come down and they came out with variable Universal Life. But then in 1997, Indexed Universal Life. Now, I've never owned a variable policy. I never will, because your money's subject to the market volatility. Indexed Universal Life came out in 1997. If you don't understand it, search it on this channel. But Indexed Universal Life allows the policy owner to be able to have their cash in the policy, whether it's 100,000, a million, 10 million. Let's use $1 million as an example here. And you're going to retire and you have $1 million in there. So I have $1 million and I want it to be available for me to create tax-free income. which a lot of people do. And you can use it anytime you need for other purposes, emergency funds, as I explain in the book I'm going to gift you. But let's say you accumulate $1 million and now you want to retire and start taking out income. Now, in the Internal Revenue Code, since 1986 tax reform, there's only 3 types of income Americans pay income tax on. Earned income, that would be salaries and wages. Okay. Passive income, that would be like rental income or lease income. And then portfolio income, which would be like interest and dividends. And that's usually how a lot of people have their IRAs and 401ks. But you have to pay tax. If you have income that's not one of those 3, then it's not subject to taxes. There's nowhere on a tax return to put it. And so money out of an insurance policy, you can take it out the smart way by using a zero cost or indexed loans. So with indexing, I get to participate when the market goes up by linking to an index, but not lose if the market goes down, because I'm not authorizing the insurance company to use my $1 million to invest out in the market. The interest on my million, the general account portfolio rate of the insurance company, which as of the recording of this episode, is around 4%, 5%. So let's say 40,000. You can accept the 4%, which is sometimes much higher than banks and credit unions pay. Or you can tell them to take that interest, that 40,000, and buy upside options in that year in the S&P 500, the Dow Jones, the Russell 2000, and they do that. So your return is linked to an index, but that gives the insurance company the wherewithal, if the market goes up, to pay you 8%, 10%. Even in this year that I'm recording this, 2021, we've had clients that have been credited 32%, 61.33%, even 153%. That's locked in. If the market crashes the next year, they don't lose that money they made. But if the market were to go down and you chose to link, the options simply expire worthless. You don't lose your $1 million. You just didn't earn any interest that year, okay? So if I have my $1 million, based upon what the American economy does, usually in a 10-year period, there's usually 7 up years compared to 3 down years. In the Great Recession, 2000, you go to 2010, there were 5 down years and only 5 up years. Using indexed universal life, our clients averaged 7.23% if they never rebalanced. They just sort of put their head in the sand and left it like it was. You don't have to do that. A good advisor will tell you when to just move over to the general account portfolio rate or when to link to a particular type of index. Okay. By doing that, most of our clients were credited 10.07. So through the years, I've earned, sometimes as high as 25%, even 61%. Other years, 0, but 0 becomes your hero because you didn't lose. But I've generally been able to earn at least 8%. Now, by using arbitrage, if I borrow $100,000 out of my $1 million, the insurance company is charging me a nominal interest rate, maybe 2% on that $100,000, but they're crediting me on the $100,000 of cash value that collateralized that. They're crediting me the same interest rate, so it's called a zero-cost loan. But you know what I do? And what most of my clients do? They do it much smarter. Before I explain the smartest way to access money, if this is intriguing you, share this video with somebody who you think ought to hear this and watch it. But I would recommend that you post a comment, click like, but subscribe. It's free, and click that little bell when you do, because then you'll be notified every time I post a new episode, which I do almost on a daily basis. I don't want you to miss out. But stay with me to the end. I want to gift you a copy of my most recent best-selling book, The Laser Fund. It retails for $20, and I'm going to gift you a copy. So let's pick up where I talked about the smartest way. Most of my clients, they understand how money works, maybe because I've trained them, but they use what is called an index loan. So when they borrow their $100,000 a year, let's say, out, they say, you can charge me a higher rate when I tell you. And that would be the years that they feel bullish about America. They think the economy is going to go up. And I sort of coach them on this. So then they may be charged 5% instead of the 2%. Why would they do that? because they're being charged 5, but they get credited on their million that they left there. That's collateralizing this annual loan because they're borrowing the equivalent of their interest. They're being credited the indexed rate. So like in 2017, I had clients that borrowed $1 million at 5%, and the insurance company charged $50,000. Now, they didn't have to write out a check for that. It's just automatically deducted out of what? Out of the money that's growing on that million. That year, they earned 25%. This year, the recording of the video, we've had people earn as much as 61.33%. So you borrow out at 5 and you get credited 61, you're netting 56%. Hello? This is where people who understand how money works are able to earn a higher rate of return on their money while they're using their money in retirement. So let me connect the dots and help you understand how this works on an insurance policy ledger. So let's say you retire, you have $1 million of cash value in your IUL policy, and you start pulling out $100,000 a year. And so whether you use a zero cost loan, 2% is what they're charging, they're crediting you to, or some years you use an index loan, you're taking out $100,000 in the form of a loan. They will charge you the appropriate rate if you borrow. And when you do that, then over on your $1 million, your full million, they're crediting you either the zero cost loan, 2%, or if it's indexed, they'll credit you, 8%, 12%, 15, 25, 61% on that money. And this is where people have made a ton of money on their cash value, even though they're using the money for income or for business or whatever. So let's say you do that for 20 years. So you have this $100,000 a year for 20 years is $2 million in this phantom loan balance. Now I say phantom because it's not due and payable during your lifetime. It'll be washed away with the death benefit when you die. So it's compounding with whatever interest, but over here it's being more than offset with the same interest or higher interest. And so there's usually an arbitrage there, usually of at least 2%. Now that's not guaranteed, but what does that allow you to do? If your index universal life policy only averaged 8, if you didn't want to deplete principal, you probably should only access about $80,000 a year to keep your million stable. But by using index loans the smart way, usually I have found that people can access maybe 2 percentage points higher, like 10%, $100,000 a year coming out, even though they're only earning 8% because of the arbitrage by using smart ways to access money, the index loan. $1 million nest egg can generate $100,000 a year tax-free. And if down the road you come across some money, an inheritance, a windfall, and you're wondering what to do with it, you never have to pay back that loan, but it doesn't mean you can't. You can put that $2 million back in and the interest that the insurance company was accruing. And the IRS says, oh, they're just paying back the loan they didn't have to pay back. The insurance company says, oh, new money, you hit the ground running and you're earning tax-free interest without having to jump through the TEFRA, DEFRA, and TAMRA hoops on that grandfathered policy. This is the most least understood and the most incredible financial instrument for retirement that most advisors do not understand. And here is the best part. The IRS and Congress has left this alone. It's a tax-free cash cow in the Internal Revenue Code now for over 108 years. Why do they leave it alone? Because when you take ownership for your future, you're taking pressure off of the government to help you during retirement if you outlive your money, or if you leave behind widows or orphans or whatever. That's why it's tax-free. So if you want to accumulate, access, and transfer your money tax-free, and you want to generate income that will never show up on the front page of your 1040 tax return, consider a max-funded IUL. I would recommend between 40 to 60% of your income not even show up on your 1040 tax return when you retire. I've been doing this for years. You want to read some stories? I want to gift you a copy of this book. Now, it's actually 2 books in one. You click on the link below, go to laserfund, LASERfund.com. Now, you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. You don't have to pay $20 retail price for it. And this side is about 200 pages with all the charts and graphs. This side is about 100 pages. You flip it over, and this has 12 chapters with 62 actual client stories showing how you can access money the smart way. So do it the smart way. Generate tax-free income for as long as you live so that you will not outlive your money. And be sure and check out other learning opportunities there. On this site, you'll see some educational webinars and events like Retire by Design. Check that out and join us on a virtual workshop.